Hello there, and thank you for joining me for my discussion on accounting for leases. This is part one of a series. If you haven't already done so, please read pages 859 through 873 and do the Learn Smart for those pages prior to completing part one of this discussion on accounting for leases. It's a rather complicated discussion, and I'm not going to take it from a beginner's perspective, but from someone who's a little familiar with this subject. Believe it or not, accounting for leases is kind of complicated. You wouldn't think so, would you? But it is. Typically, when you think of a lease, you think of going out and renting a piece of equipment, maybe a sign for your grand opening that flashes and draws people's attention to you. And you write a check for this piece of equipment, and you debit rent expense or lease expense and credit cash, pay for the equipment, and give it back after you're through using it, maybe a day or two. We call this a true operating lease. It gets its name because it's used in the calculation of operating income, and the rent goes right to the income statement rent expense, and it reflects a true short-term equipment rental arrangement. But there's a different kind of leases as well. A kind of lease where you go out and you get a piece of equipment, and you're going to have it for substantially all of the life of the equipment, or substantially pay for the equipment, and maybe it even becomes yours at the end. And if you look at the substance of this lease over the form of calling a lease, you find that you've really just purchased a piece of equipment through debt, and you've called it a lease instead of a notes payable. And perhaps a more accurate way to reflect that would be to pick up the equipment and set up some kind of lease liability. Most lease liabilities are true liabilities to the extent that if you fail to make a payment on them, you can go into default just as much as you could from a regular loan. If this is the nature of your lease, we call these a capital lease, and that refers to the fact that they're capitalized. They didn't go to the income statement as part of operating income. They're actually put on the balance sheet in an account called leased equipment, and you set up a lease liability. And this reflects more of an ownership type of arrangement. It's completely likely that you'll own it so much that you'll pay for all of the maintenance on it, you'll pay the taxes on it, and you should actually even get this, depreciating it over the period of the lease and treating it more like a piece of equipment you purchased than a piece of equipment you leased. So we have two different kinds of leases that we're going to study. True operating leases, where ownership interests don't typically transfer, and then capital leases, where you essentially own the equipment at the end of the lease. In our next video, we're going to discuss some of the differences of these leases and how you can tell what kind of lease you're working with. Thanks for joining me.